Imagine this scenario. You have spent your entire adult lifetime building a business. You have missed family dinners, survived economic downturns, and finally you are ready. The champagne is practically on ice. You have a buyer, the numbers look great, and then the phone rings, it's your accountant, and in one 5-minute conversation, the entire deal falls apart. The buyer walks away, the champagne gets poured down the sink. How does that happen? How does the person you trust most with your money become the very reason you cannot cash out?
It is a heartbreaking scenario, and the most frustrating part is that it happens every single day. Business owners naturally turn to their longtime accountant or CPA when they decide to sell, assuming that because this person knows their tax returns, they know how to navigate a merger or acquisition. But that assumption is one of the most dangerous and expensive mistakes a founder can make. We are really talking about the difference between a deal maker and a deal killer.
That distinction is fascinating because we are conditioned to view our accountants as our ultimate financial protectors. They keep us out of trouble with the tax authorities, they find deductions, they keep the books balanced. It feels incredibly counterintuitive to think of them as a threat to a business exit. What exactly turns a highly qualified, brilliant CPA into a deal killer at the 11th hour?
It comes down to their fundamental training and psychology. Traditional CPAs are trained to look in the rearview mirror. Their entire profession is built around historical data, compliance, and risk elimination. When they look at a business, they are looking for what went wrong or what could trigger an audit. But selling a business is entirely about looking through the windshield. It is about future value, strategic synergies, and managing risk, not eliminating it completely. When a traditional CPA gets involved in a complex transaction, they may see standard acquisition risks and flag them as catastrophic deal breakers because they do not have the framework to evaluate acceptable transactional risk.
So it is almost like taking a brilliant defensive coach and suddenly asking them to call the offensive plays in the Super Bowl. They are going to punt on first down because they don't want to throw an interception.
That is the perfect analogy. They will punt on first down every single time. And the tragedy is that they genuinely believe they are protecting the business owner. They will point out a minor tax liability or a structural inefficiency and advise the seller to walk away from a multi-million-dollar exit simply because they do not know how to structure an indemnity clause to bridge that specific gap. They lack the specialized toolkit of an M&A advisor.
Which brings us to the core of what actually makes a successful exit. It is not a solo mission. It requires what the industry often calls the power trio. If the traditional CPA is not the right person to lead the charge, who exactly needs to be in the room when you are selling your life's work?
The power trio is the absolute gold standard for a successful exit. You need 3 distinct pillars of expertise. First, a professional business broker or M&A advisor. They are the quarterback, they understand market valuation, they know how to find qualified buyers, and they maintain the momentum of the deal. Second, you need a transactional attorney. Not the lawyer who set up your LLC 20 years ago, and certainly not the lawyer who handled your neighbor's divorce. You need an attorney who specializes exclusively in buying and selling businesses. And third, you need a transaction-focused CPA or financial advisor.
Let me stop you right there because I want to dig into that third pillar. You are saying you still need a CPA, but a different breed of CPA. What does the transaction-focused CPA do that the traditional tax CPA cannot?
A transaction-focused CPA understands the architecture of a deal. They know how to perform a quality of earnings analysis, which is vastly different from a standard audit. They understand how to structure the sale to minimize capital gains taxes legally, whether that is through an asset sale versus a stock sale or utilizing specific trust structures. They work in tandem with the broker and the attorney to find solutions when a problem arises in due diligence. If the buyer finds an issue with inventory valuation, a deal killer CPA says, the deal is off. A deal maker CPA says, here is a financial structure that adjusts the working capital target so both parties still win.
That is a profound shift in mindset. It is the difference between finding roadblocks and building bridges. But I have to imagine this creates an incredibly difficult emotional situation for the business owner. You have a founder who has trusted their local CPA for decades. The CPA has been to their kids' weddings. Now the founder is preparing for the biggest financial event of their life, and they are being told they need to bench their most trusted advisor. How does a founder navigate that emotional loyalty versus the practical reality of needing a power trio?
That is usually the hardest part of the entire process. It is a massive emotional hurdle. Business owners are fiercely loyal, and rightly so, but you have to separate personal loyalty from fiduciary responsibility. The best way to handle it is through honest communication and role definition. You do not have to fire your longtime CPA. Instead, you redefine their role for the transaction. You tell them, "You are going to handle my personal tax strategy and wealth transition post-sale, but I am bringing in a specialized M&A team to execute the actual transaction."
It is almost a philosophical shift in how we view the life cycle of a business. The people who help you build and maintain the ship are not necessarily the navigators you need to guide you through a treacherous harbor into a new port.
Precisely. And the cost of not making that shift is staggering. I have seen deals fall apart over a $10,000 discrepancy in a $5 million transaction because an inexperienced accountant dug their heels in on a point of pride. When a deal collapses, the fallout is not just financial. The business owner experiences severe deal fatigue. Often, the business itself suffers because the owner took their eye off the ball for 6 months to focus on the sale. Employees might get wind of the failed sale, leading to panic and turnover. The ripple effects of a killed deal can literally destroy the legacy of the company.
That really puts the stakes into perspective. It is not just about missing out on a payday. It is about protecting the ecosystem you have built, the employees, the community, the family's future. It makes me wonder about the buyers, too. How does a sophisticated buyer react when they realize the seller is being advised by a deal killer CPA?
Sophisticated buyers, especially private equity firms or serial acquirers, can spot a deal killer CPA from a mile away. And honestly, they hate it. You might think a buyer would love an inexperienced seller's team because they could take advantage of them, but that is rarely the case. Buyers want certainty. They want a smooth, predictable process. When a buyer realizes the seller's CPA does not understand basic M&A terminology or is holding up due diligence over irrelevant details, the buyer loses confidence in the entire transaction. They start wondering, if the financials are being managed by someone this out of their depth, what else is hiding under the hood? Often, the buyer will just walk away to find a deal with less friction.
So having the wrong advisor actually destroys your credibility in the marketplace. That is a terrifying thought. Let us pivot to the proactive side. If I am a business owner listening to this and I am thinking about selling in the next 2 to 3 years, how do I audit my own advisors? What are the specific questions I should be asking my CPA right now to figure out if they are a deal maker or a deal killer?
That is the exact right approach. You need to stress test your team long before you go to market. Sit down with your CPA and ask them directly, how many business sales have you successfully guided through to closing in the last 3 years? If the answer is 0 or 1, you have a problem. Ask them to explain the difference between enterprise value and equity value. Ask them how they would approach normalizing SDE or EBITDA for your specific industry. If they look at you with a blank stare, or if they immediately pivot the conversation back to your standard tax deductions, you know they do not have the M&A toolkit.
I love that. Normalizing SDE or EBITDA is such a great litmus test because it requires understanding the narrative of the business, not just the raw math. You are adding back one-time expenses, owner salaries, things that show the true cash-generating power of the business. A tax accountant wants to minimize profit to save on taxes, but an M&A advisor wants to maximize normalized profit to increase the valuation. It is literally a tug of war between two entirely different financial philosophies.
You hit the nail on the head. It is a complete paradox. For 20 years, your CPA has been artificially suppressing your profitability to keep the IRS away. Now, suddenly, you need to show the world how incredibly profitable you really are. You cannot expect the person who built the camouflage to suddenly become the expert at shining the spotlight. That is why the power trio is non-negotiable. The broker drives the valuation and the market strategy. The transactional attorney builds the protective legal fortress around the deal. And the M&A CPA translates the historical tax data into a compelling, forward-looking financial narrative.
It is a beautifully orchestrated symphony when it works, but it requires the business owner to act as the conductor, making the tough decisions about who gets to sit in the first chair. As we wrap up this discussion, it feels like the ultimate takeaway here is about evolution. The business has evolved, the market has evolved, and the owner's advisory circle must evolve with it.
Absolutely. Selling a business is not just a financial transaction, it is a profound life transition. It is the culmination of decades of sacrifice. You owe it to yourself, your family, and your employees to protect that transition with the highest level of expertise available. Do not let loyalty to a comfortable past jeopardize a highly lucrative future. Surround yourself with deal makers, build your power trio, and step into your exit with absolute confidence.
A profound life transition. I think that perfectly encapsulates the weight of this topic. It is not just numbers on a spreadsheet, it is the final chapter of a tremendous story, and you need the right co-authors to help you write the ending. It leaves you wondering, for anyone listening who is building a business right now, are the people sitting at your table today truly equipped to walk you out the door tomorrow? That is a question every founder needs to answer before it is too late.